Well, hello, everyone. Once again, thank you for joining today's webinar on the Financial Time Series Analysis using R. This is Cynthia Tomaine with Interactive Brokers, and we're very pleased that you've joined us here this afternoon. I'd like to take a moment and introduce our speaker, Majid Zaman, who is going to be delivering today's presentation. Now, Majid was a speaker at our Finance Conference in 2016. He's an expert on integrating numerical analysis and statistical theories. He's also interested in the application of quantitative analysis to solving real-world problems, mathematical and statistical analysis in making theoretical advances in financial economics as well. He's also interested in portfolio and asset pricing theory, as well as computational and statistical learning. Majid is a PhD and is also a graduate assistant at Rensselaer Polytechnic Institute. So please join me in welcoming Majid for today's presentation. Thanks for joining us, Majid. I'm going to go ahead and pass the controls for today's session over to you right now. So let's get underway. Thanks for joining us, Majid.
Perfect. Thank you so much, Cynthia. I assume everyone can hear me now. Okay. So I would like to start with the presentation. So thanks a lot for having me here. Actually, at the moment, we're presenting the presentation at Rensselaer Polytechnic Institute, and currently we have also here a number of participants. So we're looking forward to have to start the presentation. So just basically. About me, I'm as Cynthia mentioned, I'm a PhD finance candidate at RPI. My research interests are in banking, risk management. I also look into financial networks and interconnectedness, and part of other research I do is related to portfolio and asset allocation theory, which also has emphasis on asset pricing. And then finally, I'm interested in computational statistical learning. So if you want to contact me, feel free to do so by writing me an email or finding me on LinkedIn. I also have the homepage. You can actually access it, and then I have like a small R corner that has some applications, and part of it's going to be having the source code for today's presentation. So if you just feel free to click in the homepage, it should allow you to go there, and then as soon as you go to my homepage, there's a R corner. So basically, you can be able to access the R source for today's Financial Time series using R. You can either copy-paste or just basically download the actual file. So feel free to do that as soon as we go into the presentation. And before I start, I'd also like to make an acknowledgement. Special thanks to Violeta Petrova, who's with the Interactive Brokers, and of course, Cynthia Tomaine. For organizing this. And special thanks to Professor Shofi. He's here. He's also the faculty advisor to the student management at RPI. They did very well last semester. They outperformed the benchmark by 1%. So that's good. So you can actually get more information about their performance by clicking on that link over here. And then, of course, thanks to the Lally School for hosting this in person. So that's where I am right now. So my agenda for today, I would like to give a small intro to R and Financial Time series. And the very important topic when we think about Financial Time series, it's really important to understand whether the time series is stationary or not, because sometimes one will have the tendency to start analyzing and use predictive models, but the main question remains like, is the data stationary, and why is that important? I'm going to then go to ARIMA models, basically briefly go through it and then explain how we can actually apply that in R. And finally, I'm going to do some experiment for forecasting. If you look at Financial Time series, there's the classical, there's a classic textbook in time series that's considered like the holy book by Hamilton. It's a very thick book, and it's kind of like very standard in Financial Time series. It's very detailed. I really recommend that if you have the time to go like through the topics. You can find like a lot of interesting topics in it, whether univariate, multivariate time series, whether spectral analysis. It just like covers all over. So in terms for application, I would really there's like interesting sources online for time series using R. One of them is basically econometrics in R. It's kind of like open lecture notes by an author. I think it's available at MIT, so you can actually find the reference. It's 70 pages, gives you like overview in econometrics, how to apply it in R, and it has this section for time series. The other one would be Tsai. He's like very productive. He has a lot of books. One of them is The Introduction of Analysis of Financial Data with R. Another good book. Jeff Ryan, who's the author of the time series package, XDC, also has like a webinar on DataCamp. Sorry, has like an open course in DataCamp. So also like a great source to understand how you can actually manipulate time series. And then if you want to go forward, there's like more advanced time series. One of them is looking at more multivariate time series. One is Puff. He's also one of the contributors to the R community. He's an active speaker at the R in Finance. And then Tsai again has another book on multivariate time series analysis. So I would recommend that if you want to look at multiple time series. So as to start, I would like to look at the basic things. I assume that because we're going to do that using R today, so I assume that everyone will be able to get the R system, the base one, and then we'll basically get the R Studio, which is kind of gives a very nice platform to do the analysis, and it's very convenient. Secondly, I'm going to be looking at data through interactive brokers. So to do so, if you have an account, you can actually go through your workstation. So that's kind of like gives you a software for your laptop, and you can access your interactive brokers through the software rather than a web page. And the other one is basically that I'm using right now. It's the IB Gateway. So that gives you a nice access through their API, and that will integrate R to the interactive brokers system. Now, as to start, I would like to just basically briefly go through the XDC package. XDS package it's authored by Jeff Ryan and Ulrich, as well another great contributor to the community. And the package provides efficient ways to manipulate time series. So here's just a small example. So in R, basically, you want to call the package the library, and then I'm going to call library XDS, and then library Lubridate. That's another nice package if you want to like work with dates in R. It's kind of very convenient way to actually extract dates and assign them to an object, time series, or data. So what I'm going to do, I'm just going to like simulate some random data from a normal distribution. I'm going to like simulate 100 observations. And then what I'm going to do is basically I'm going to look at the X, and then I'm going to somehow assign it number of dates. And then I'm going to call X as an XDC, and that's kind of basically somehow an efficient way just to create like a random time series. Now I would like just basically to go through R and show how it can actually be done. So let me go to the R Studio. This is the source code that I have. And then I like to start with a fresh start, so I'm just basically removing anything that I have in history, and then I'm going to run this code that you just saw. So I'm just going to write log this, and basically, so what I get if I just basically type X here, I get this kind of like time series. So the way I did it, basically, I started with just looking at X. In this case, just X will give me some random numbers from like 100 observations. And then I'm going to call something as date labels. So something just to assign. So basically, the date labels will give me like all the dates from today, because I'm going like from today. And then the nice thing about the local date is basically I can think about date as a numeric. So I can like take -0, -1, and that will basically go yesterday, etc. So that allows me to pull out data just by, using just basic numerical operations. And then I call the name of X, and that's basically assign all of these date labels to X, and that's what happens. I get this X, a vector with these names. And finally, I'm just going to use the as XTC, so I'm going to assign it as a time series, and then X will take this form. So it's like in multiple steps, but it's just to illustrate that how XDS actually understand time series. And then finally, if we have this, I can just basically, if I want to pull the data from today, I just can write X, and then I write today, and it gives me what's the corresponding number from today. Another way is basically, which is nice, I can just write one function, which is plot, and that will give me a plot for the time series X. So that's another thing nice about this package. Another thing you can actually use, so let's say that this data actually is daily, because we see that we go like from today, we go backward till for 100 days, and then there's the package has like a nice functions, which basically looks at monthly frequency or quarterly frequency. So let's say I want to find what's the maximum value for each month in the data, in the time series. Then I would write apply monthly. I will put what object I want to apply on, and then I will use a function. So in that case, I'm taking the maximum value. So when I do this, this is what I get. It corresponds to the last data in the month, right? So it kind of represents that, but at the same time, it's taking what's the maximum value in that corresponding month. The same thing you can do it for quarterly or weekly or annually. This is another example for quarterly. So basically, we have 2 quarters, and that gives you the maximum value. So obviously, if you look at the, from this case, the maximum value would be from April for the 2nd quarter. And then another thing is that what you can do, you don't have to use only one defined function by R, because max is basically gives you the maximum value from an object. You can actually design something. So the way to do that, let's say we want to do that apply quarterly, and then we go apply an X, and then I design my own function. So that function will basically look at the average of a value divided by the standard deviation of the value. So this allows me to look at what is the maximum ratio for each quarter. So you can think about it, if I'm looking at financial data and I want to look at the returns over standard deviation, something like capturing the Sharpe ratio, and I want to see what is the maximum Sharpe ratio, or what's the Sharpe ratio for each month. So that's kind of like a very nice function to apply it on different frequencies. So that's kind of like the very intro, small like a crash course in R to the as an introduction to the XTC package. The other thing I would like to show that if you prefer working with data frames, there's also, you can just, instead of looking at X as a time series, you can look at it as a data frame. So one trick is basically you can look at X instead of you will use the data frame function, and you will use a variable called date, and then because it's a time series, it will relate what's the date of the time series. So basically, it will assign a date variable based on the time series date, and then it will take a X variable as what is the actual time series is, and then you can actually run the summary, and then you see basically it has 2 variables, one for date and one for X. The other thing is I can also add like values for, if I want to add what's the year in the data and what's the month, I can create like basic variables using the $sign. And there's a nice package in R, it's called TLYR, which allows you to look at splits in the data. So let's say I want to repeat the same analysis by looking at what's the maximum value over a month. So then I just can repeat that by using a function called DDPLY. So what it does, I apply a function on X, that's my variable, and then I want to look at with respect to the years and the months, and then I will use this function, which is takes what's the maximum value for the for X, because when I apply this function, it reads it as different data splits. So what I have to do is you can think about Z as the data for each month here, and then I want to pull out from Z, that's sub data. I want to pull out the X. I want to apply what's the maximum value for that. So that's another way. If you're more comfortable working with data frames in R, feel free to do that. But I highly recommend using XTC because it gives you a lot of convenient ways to actually summarize and analyze time series. Okay, sounds good. So if I'm planning to have like a Q&A session at the end of the seminar. So if you have any questions, I will be happy to answer them by the end. Uh, so please feel free to put the questions down. I will assign like the last 20 minutes of this session just for the Q&A. Okay, sounds good. So this was like an introduction to the time series. Now what I want to do is I want to look at the how you can actually integrate R to the interactive brokers. So again, kudos to Jeff Ryan, who actually who wrote the package for interactive brokers and how you can actually integrate R with the interactive brokers trading workstation. So you can actually also not only you can actually get data, historical data, and analyze it through R. You can execute trades and automate them just using R by running the code. So if you want to look more into that discussion, I would recommend to see the recent webinar, which also was hosted by Interactive Brokers by Anil Yadav. And feel free to click on the link here to go through that presentation. Let me see. Sounds good. Okay, so this is how the package works. So in order to run the API, I would like to just to show you something. So you can either have the you can either have TWS workstation, or you can actually use the gateway. So I'm using this one with Interactive Brokers, and then what I have to do is I need to put my username, which was 839, and then I'm going to sign in. Okay, so this is basically, it's very basic platform. I just show you that you're connected, and then I'm just going to, I understand and accept. So now I'm connected to the Interactive Brokers API server. Now, when you do that, make sure when you go to the settings that you have the right port. In that case, would be you should have this number. So when you go to the API settings, make sure that you have the socket port assigned to 7496. Now, after I do this, it says I'm connected. Now I'm going to go to the R session. And then I'm going to start again with a fresh start. I'm just going to delete anything before. And then the first thing you want to do is you want to do like the TWS connect. That's the package from the IB brokers. So make sure that you load the package. Of course, you have to. Yes,
this is Cynthia here. We're still looking at your slides.
Oh, sorry. So you can't see the.
No, we can't see the desktop. If you can.
Okay, sure. Sorry. Thank you for telling me. Okay, let me just see.
There we go. Much better.
Okay, so you can see it now.
Yes, we can.
Okay, thanks. So what I was saying that you wanna. I'm using the IB gateway. So I was just mentioning that when you log in, make sure that the settings in the API is assigned to this port. And after you do so, you see this is connected. You want to go to R, and then you want to load the package for Interactive Brokers. And then I'm going to use the TWS connect function. So let's see what's going to happen. I'm just going to put this command, and then after I do this, I'm going to double check if I'm really connected. So there's a function called sConnected, and I look at what I actually define as the object for that connection. So let's see what's going to happen. So it says true, which means I'm connected, and then let's go back to the gateway, and then you can see that actually the client has been connected to the gateway. Now, the other thing is that let's say I want to look at my account, so you can actually require the account update. And that gives you like kind of different information about how much details about your account. Now, the other thing is that what I'm going to do for the purpose of this presentation, I'm going to try to look up download data from the interactive brokers. So I'm going to look at the SPY ETF as my security. And the way I'm going to do that, I'm going to run this command. So I'm going to define security, which is now not defined, and I'm going to call it this thing is security. And basically, this is how R reads it. So define it as an own security inside the system. Now, the other thing is that you want to double check, is it really identified? So you can actually go and look, is TWS contract? And that gives me true. Now, after I did that, after I define a security, I'm going to look at, I'm going to ask R to download the data historically. So usually the data goes back to 1 year if you're using a paper account. And I think the minimum, the highest frequency you can get in this case is 5 minutes. So I'm going to get like 5-minute sticks over the last year. So that's kind of like 250, 2 days multiplied by almost 80 ticks a day. So let's see what's going to happen. So I put this command, and then TWS message, it says that it's waiting for TWS reply on SPY. And wait a little bit. Yeah, usually it takes a little bit of time. I think also that if you want to download multiple securities, there's limitation how many you can actually pull in some time interval. So I would recommend like looking into this through the Interactive Brokers API. There's some limitation would apply. Well, okay, so that's good. Took a little bit, but so let's look at what we got here. We got this new item called P. So I'm going to look at a head of P, and that basically gives me a perspective on the data. So if you look at the data goes back to June 2016, and it has a number of variables. It has the open price, high, low, close, the volume, and then basically it gives you the weighted average for the price, given the trades that happen in that interval. And what also you can actually see that the class of P is given by, so because it's designed through the interactive brokers, so when you read the object, it's going to be either as XTC and Zoo, which is kind of related package for time series. And then if you want to look at a summary of P, you can actually just have another perspective on the data. So you can see that the minimum date is June 16 from last year, and the maximum basically brings us to today, the June 15. So you can actually get like buy now data. So let's see if I look at tail of P. So the last tick I have like from 12:20, just like 5 minutes ago. Okay. So another thing is that, as I mentioned before, you can actually look at another function from XTC and apply directly in the data. So in that case, I can look at I will look at the date today. So I'm just going to pull it up, where is today, and just have perspective. And then the nice thing about R, it has like these functions, the apply functions. You can run multiple runs in different securities. So in this case, I can do, if I look at the number of multiple securities, I want to pull that data. So I can create a list. I call it vlist. And then I want to like look at multiple securities. So then what I'm going to do is similar to what I did before, but I'm going to generalize it to a number of securities. And then, so the vlist is basically going to be just a string of these ETFs. And then I'm going to look at the security list, just going to apply that. And then, as you can see, similar as before, we have now defined 3 securities in R. And then what I can do is just like double check that everything is designed as a contract, and then I get true, 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 which is basically that's the case should be. And finally, what I can do, just apply the same function from before as I did in this case, where I define what P is. But now what I'm going to do is just going to use this lapply function, which kind of like applies in each one of these securities. I'm going to pull out the data. So I can do that. Let me apply it, and then we go back to the slide just to make sure that we get the data. So it's going to like run on each one of these. So it's going to start with the SPY and then move to the other ETFs. So that's basically pretty much how you can actually get the data from R. It might be some limitation if you're using a paper account and you haven't used the account for a month. So you might be unsubscribed from that data. But for the purpose of this illustration, I'm just going to assume that everyone has the SPY data and move on. This is just a slide describing what I just did now with the R Studio. And let's move forward. So the next topic is going to look at the stationarity and why it's important. So I'm going to like go through a few concepts just to cover that. I really like to cover the art of time series, and that's what we're going to do. But I think also it would be nice to cover some science behind it and why does stationarity matter. So usually there's two definitions of stationarity. We're going to like rely more on the weekly stationarity. And one of them is if you look at YT as a process that we observe over T periods, weekly stationarity implies that the first two moments of the time series are time invariant. So you can think about this process should have the same mean over time. It varies, but it's kind of like stable. And the same thing for the variance. You can think about the variance is actually, it's stationary in the sense that in total the variance will actually not be time invariant. So the other stronger stationarity term would be strictly stationary. That happens if you look at two time intervals, two time periods, and then if they have the exact same distribution, then you would say that they're strictly stationary. So that's like a harder condition to satisfy, and most of the time when we talk about stationary, we're thinking more about the moments, which is the weak stationarity condition. Now, another thing we're going to look at linear time series. I think it's kind of very intuitive to look at linear time series, even though like life is not really linear. If you're interested in nonlinear time series, there's like more packages and lectures in that. But now I'm just going to cover the linear case. So here's just an example. I'm going to look at autoregressive process where YT is given by some sort of mean plus some lag value plus some noise. We're going to look at these noises as a sort of which we call white noise. It means like it has a stationary distribution over time, and it will have the same moments and would be serially non-correlated. So it means like every time it's very independent and it happens over again as a stochastic process. Now we're going to focus on the meaning of this phi. So if you look at the definition, theoretical definition of this phi would be something that captures what's the correlation between the process today and the process from yesterday, for instance. And that kind of captures the serial correlation. Now, if the magnitude is very large, which basically equals to 1, you can actually think about it that the process is going to be like very serially correlated, and that makes the process very persistent. And that brings us to the concept of unit root. Now, when we think about weak stationarity, we said that the variance should be the variance and the expectation, there should be constant over time, and there should be finite. So one case, if you look at a small exercise, if you look at the definition of the expectation of YT, you get this term. And then if you look at the variance of YT, you get this term. So a small illustration is that if this phi is going to be equal to 1, you can see that the process becomes explosive in the sense of that the variance is going to go to infinity. So basically, a one condition for weak stationarity would imply that the magnitude of phi should be less than 1. You can think about a fraction that you multiply by itself. Over time, it will go to 0. So hence, the concept of unit root basically implies that if phi is equal to 1, the process YT is going to be a unit root. And we're going to discuss how we can actually test for that. But But I would like to also look at why we care about unit root or not. Well, the main problem is if we look at non-stationary data, a problem would be is we cannot forecast a non-stationary data because by nature it's going to be like non-stationary. It's going to be going to infinity and will not go back where it started. So you can think about a process that stationary around 0. So we know like if it goes too much beyond 0, it will come back to 0. So you can actually put some sort of predictability into the process. Now, the other thing is that if you look at the results from non-stationary, they could be spurious. If you look at stock prices, for instance, they're very highly correlated over time. The question is, why is that? Well, the reason is if you look at stock prices, there's a time dimension which makes the process very serious correlation. It doesn't mean that the prices by themselves are highly correlated. Here's just an example. If the process has unit roots, you can actually see that you can translate the process as a sum of all these noises. The intuition behind this is that the noise you had from like 10 days ago will be very persistent. So just a small illustration that as long as you move in time and the process is non-stationary, all the noise that you had before is going to accumulate and the process is just going to basically explode. So this is basically pretty much with the idea. And then what we're going to look at, transformation and integrated processes. So what we're going to do, we're going to look at the first difference. In that case, if the process follows a unit root and we look at the first difference, what's going to happen, we're going to see that the process becomes equal to that noise, which we consider the white noise. So, which basically means that at each time the difference in that process is given by something new and not depends on the past. That basically introduces the idea of the process becoming stationary. So we're going to focus on the first difference, and in that case, we're going to call Y an integrated process. For instance, if Y has a unit root, well, the first difference actually yields a stationary process, then what we're going to call Y is an integrated first order, which means that if Y is non-stationary, take the first difference, you're going to end up with a stationary process. Okay. Finally, I'm going to illustrate this in an example. So I'm looking at the SPY ETF data, and here's an example. I'm going back 1 year in the past, and one example is you can show that in that case that the mean before and after is basically it's different. So just like look at the first moment, you see that the mean here is over is around 215, and in that case it's around 235. So that's just like looking at the prices of the SPY ETF. On the other hand, this is kind of like an illustration of the strict stationarity. I want to look at the distribution in the first half of the period, and then look at the empirical distribution of the second half. As you can see, it results in two different distributions. So these plots basically illustrate what the distribution in the first period, and then the blue one basically illustrates what the distribution in the second period. So this is kind of like an illustration of the concept of strict stationarity is being violated in this case. Now, how this first difference actually relates? So what I'm going to look at, let's assume that the PT, the process of the SPY ETF, is denoted by PT, and then I'm going to look at the log, natural log of the prices. Now we know that if PT is a unit root, non-stationary process, then I'm going to look at the first difference. So the first difference in that case, it somehow resembles the returns on the asset, right? So I'm going to look at the first in the log, and that kind of like captures what the approximation for the return on the SPY ETF on a daily basis. And then I'm going to repeat the same experiment, looking at the plots before, but now with just respect to return. The first illustration, looking at the weak stationarity, we see that the process looks more stationary and more consistent. So looking at the two periods, it has the same mean. The same thing applies when I look at the strict stationarity. Now I'm looking at the period before and the period after, and you see like the distributions are becoming more consistent with each other. So that's like another illustration of how integrated process actually becomes stationary. Of course, you always can test for unit root, but I really recommend before you run any test to look at the data, visualize, and see what's happening. In that case, I want to look at the closing prices for the SPY, and then so in that case, when I look at the serial correlation for the SPY ETF, I see that the correlation is very high. It's almost like around 1. So that should be an indication of a unit root in the data, because you see that the process is very, very highly serial correlated. On the other hand, if I look at the return of the SPY ETF, you see that basically the serial correlation is much lower. It's almost like around 7%, and you see it's basically negative, which basically means like it's kind of like contrarian process. So it's always good to look at before running any statistical test, just like to see what the data is telling us. And this is another example that when you think about the prices, they're very correlated. But if you look at the returns, they're not correlated. So that's kind of like the intuition behind like having something spurious because of non-stationary. So you look at the prices, they seem to be very correlated, but what matters when you actually look at the returns, they're not. That's not the case. Finally, we're gonna like discuss how you can actually test for unit root. It would be nice if you just like have some sort of automated program. Why should I bother looking at the data and then just like I want to test it? Is it stationary or not? Of course you can do that, but I really recommend looking at the actual data before running any test. So the famous one is called the EDF, Augmented Dickey-Fuller test. And basically it tests the null hypothesis where there's a unit root in the data. So the more negative the statistic is more likely we reject the hypothesis of having a unit root. So the more negative, the more likely the data is stationary. So again, from the package of T-series, it allows us to look at the test. And then what I'm going to do, I'm going to run the test on the daily prices and the daily returns. In that case, when I look at the daily prices, I get this statistic, which is basically minus 2.36. And then if I look at the p-value, it's almost like around 42%. So large p-value means that we're not going to reject the null hypothesis, which kind of implies that we have a problem with unit root in data. On the other hand, when I run the same test on the daily returns, I get a more negative statistics and a much more lower p-value. In that case, small p-value means that I do reject the idea of unit root, which is kind of evidence to support that the process is actually stationary. So you always can run that, and then you can see actually whether the data is stationary or not. So that's another like statistical evidence to support your conclusion about whether the process is stationary or not. Okay. So to move forward, I'm going to look at the ARIMA models. So ARIMA models basically stands for autoregressive integrated moving average. So autoregressive in the sense is how much the process is persistent as part of the lag values of the process itself. Integrated, it means like is the process stationary or not, and what's the integrated level order. So in that case, a unit root would be integrated at level 1. We take the first difference, and then we get a stationary process. And then moving average, which basically look at that the process basically has some sort of average of these shocks that happen over time. So just small, a number of concepts just to basically describe ARIMA model. Usually the model is identified by 3 parameters. The P basically says what is the order of autoregressive model. D is what is the order of differencing to yield a stationary process, which we call as I0. And then Q is the order of the moving average model. 2 examples. If we look at ARP, which is an autoregressive with P lag values, then that would be a sort of special case for ARIMA models, which is ARIMA with P00. The same thing applies for the moving average. So moving average with Q that looks back at Q residuals, that would be a special case for ARIMA model in which would be 00Q. Now, let's look at a special case. Let's say that Y has a unit root, and then the first difference we know is going to yield a stationary process. Now, if the difference actually follows an AR process, then we can say that YT has an ARIMA model with 1, 1, 0. Now, given this, the question is how we can actually identify what the ARIMA model is. There's a number of steps that I recommend. The first one, which we covered, is looking whether the process is stationary or not. And in that case, we want to see what is the order of integration. Most stock prices will be integrated order 1. You look at the prices, they're non-stationary, but then as soon as you look at the differences, which implies the returns in the asset, they're kind of like more follow a stationary process. Now, the other thing is that how we can identify what are the AR and MA processes in the data series. So one common approach is to look at indicators on the autocorrelations. One of them is look at the partial autocorrelation function as a function of the lags. And that basically corresponds to the AR model. And then the other one is looking at the pure correlations with respect to the lags. So that's more applied to the moving average. I'm going to run 2 examples just to illustrate that. But the other one is there's also you can look at information criteria. For example, you can look at the AIC, and you want to see that what model like this best describes the actual data. So in that case, you can actually look at the, I want to tune the model. You can think about a sort of tuning. And then I want to see what are the orders that basically makes the data be best described by this model. And then the last thing after you identify the model, if you think you really did, because we never know where the data comes from, but if you think you really did, I would recommend looking at the residuals of that model. And if these residuals follow a sort of white noise process, then we can say that the identification is complete. There's one nice test if you want to look at for the final step, and that's the Lejeune box statistic. And basically, it allows you, after you identify the model, look at the residuals from that model, and then see whether actually they're follow a white noise, or in that case, we're just going to imply by white noise as a residuals that are independent over time. Then a value of 0, which is basically a large value, implies a good fit. So to move forward, I would like just to go back to the R console. And then I prepare a number of examples in the code. Okay. So I would like to look at 2 processes. The first one I'm going to look at as a moving average with order 2. So again, I'm going to simulate some data. I'm going to choose 1,000 observations. And there's a nice function which basically allows you to simulate data from a ARIMA model. So I'm going to choose to simulate data from a ARIMA model, but I'm going to make it of the order 002. This implies that I'm simulating data from a moving average process with 2 lags. And then I can actually put what the actual parameters of the model should be. So in that case, what I want to do is I want to create a time series, but I want to be able to reverse engineer it, so I make sure that the data comes from this model. So let's see what's going to happen. I'm going to look at generate this much of data, and then you can actually just plot the data. You'll see this is how it looks. Kind of like stationery around 200. And then what I want to do is I want to look at that autocorrelation function that I just mentioned. So in that case, what it gives you what's the serial correlation of the process over the lag. So this would be the first lag. So you see the process is very correlated over 1 lag. And then the process would be also kind of still kind of serial correlated over the second lag, but then that would be basically go away. So that's kind of like a good perspective to see how the data looks like. And then you can actually make, it kind of like implies that the process follows an MA too. So that's kind of like the rule of thumb. So if you see like there's two significant serial correlations, which is basically, you can think about these lines as sort of confidence interval. So anything beyond that will have like a significant indication. So that's one way to look at it, to see that actually the process comes from an MA2. The other thing is, I want to look at AR2 process now, an autoregressive with 2 lags. And then again, you can see that if you plot, again, it's a stationary process, as you can see, it's around 200. And then I want to look at, if I just do the autocorrelations without the looking at the condition, the partial one, let's see what's going to happen. You see, you get like this, all these serial correlations, which basically, if we were to think that the process comes from a moving average, then you would say it's a moving average with a lot of lags. Well, the reason is there's a relationship between an autoregressive model and a moving average model. So you can think about an autoregressive model of order 1 that can be actually translated into a moving average with a lot of lags. There's a theoretical property between the two. And that's why it could be misleading just to look at the ACF by itself. So what I recommend is looking at the partial correlations in that case. And in that case, will give us a sort of evidence that we have actually 2 lags in that case. So there's like some art into it, how to see like what the process could be. But if the process just were to come from either an autoregressive or a moving average, then it's kind of like easy to tell which one comes from which and what could be the possible number of lags. Well, that's one way to do it. Now, the other way is like to do the computational way is to look at the some sort of information criteria. So going back to the slide, what I'm going to do, I'm going to look at a simulated process. It's going to come from ARIMA 312. It means that it's going to be a unit root process. But when you integrate it, it will have an AR1. Sorry, going to have an AR with 3 lags, and then going to have a moving average with 2 lags. So I'm kind of like complicating things a little bit, just to see how we can actually identify something in real life. So the first thing what I'm going to do is simulate this process like I did before. And then I'm going to, first thing to do is just like plot the time series, see how it looks. And as I did before, see whether it has a unit root and whether the process is stationary. So in that case, what I'm going to do is I'm going to run again that unit root test, the ADF. And then I see that I get a large p-value, which basically indicates that the process follows a unit root. And then what I'm going to do, I'm going to look at the first difference of the process. And in that case, when I look at the first difference of the process, I get that the process actually I have more evidence that the process becomes stationary. So in that case, I'm able to identify the first order of the model, which is the differencing. So I'm able to know that D is equal to 1. So in that case, we can say that the model for ARIMA with some P, order 1, and Q, which is we still don't know. Now, here's what I'm going to do the next step. There's some ways to look at the process from these nice serial correlation functions as you plot them, but it might be a little bit complicated when you look at both autoregressive and a moving average together. So what I recommend is try to look from information criteria perspective. This is what I'm going to do. I'm going to look at what is the AIC value. So in AIC terminology, the lower the value is, the better fit the model is. So I'm going to run for different P and Qs. P is going to take values from 0 to 4. And then Q is going to take values from 0 to 4 as well. And then I'm going to look at what is the optimal AIC. So in that case, I see that the minimum value is actually given by 3 and 2. So in that case, it gives us indication that the process actually comes from, because we already know it's ARIMA with 1 differencing order, then we can actually find some evidence here. What are the P and Qs? So this is kind of like a way to actually to see what are the best fit using different P and Qs. So this is like which I done manually. So I kind of like I look at different possible values, as you can see the R code here, and then I just run that for different combinations, and I got like 25 possibilities, and out of which I get what is the optimal combo. Now, so we can find an evidence that the P equals 3 and the Q equals 2, because in that case we cooked the data in the sense of we know where it comes from. So there's like nothing really surprising, but just an idea that it gives you confidence that you can actually reverse engineer something because you already know. But when we look at actual data, we didn't really know what's the data generating process is. We assume that it follows a certain model, and then we try to fit it as best as we can. But in real life, we don't really know what's the actual generating function is. But at least we can find, in this case, we can reverse engineer something and see where it comes from. Now, the other thing is that the R has a nice tuning function. It's called auto ARIMA. So when you use auto ARIMA, actually, you give it a time series, and then it will tell you what is the actual, what's the best identification for that process is. And not surprisingly, in this case, because we know that the process comes from ARIMA 312, you can actually see when I auto-tune the model, I get identification of ARIMA 312. In that case, actually, it also gives me, if you look at the model, it estimates the model. It tells me what should be the actual coefficients for each lag value, which is consistent with the actual, definition of the time series, because we used actually 0.8 for the first lag, minus 0.5 for the second lag, and 0.4 for the third lag, etc. And then if you look at the AIC criteria in this case, this is consistent with the table we had before, which was this value, 2,844. Now, in either case, we see that the results are consistent, and that indicates the model follows ARIMA 312. Now, finally, is that after we identify the model, we want to check as, let's take a look at the residuals. What is the residual? We can think about it as, I look at the data, and I say that some of that process will come from lag values, and the other process will be something just I will never be able to predict, something like very random and not time persistent. So the idea is that after you identify the model, look at the residuals and see how they look like. The idea is that these residuals basically should be they should be not serial correlated. So that's basically looking at the pure serial correlation of these residuals, and you can see they're all like pretty insignificant. So the more insignificant these are, finally, you can think about the process has been pretty identified. And then also you can run the same test that I mentioned to get like some statistical evidence. In that case, large p-value implies a good fit for the model, so which basically implies that the residuals come from a sort of independent process over time. So to show you how it works, let's go back to the R. Then I'm just going to run this. Just going to show you how this plot works. Okay, so what I'm going to do here, I'm going to look at different ARIMA models. I would say that let me look at the first model that has ARIMA 110, which we know that's not the true model. And then I'm going to plot the residuals and see whether actually they follow white noise. So I see that basically that's not the case. So that's kind of like evidence that the model is still under-identified. Now I'm going to add then another moving average component and run again the plot. I still see there's like, I see it's inconsistent with the idea of having independent identical residuals over time. And I'm going to repeat this thing, and then I'm going to add another lag value for the AR process. And then still, and then going to keep going. We still don't see anything. And then finally, which is the true model, when I look at ARIMA, the last definition, ARIMA 312, finally we get this plot. So this is just like an indication you can actually test to see whether the model has been fit or not. So this is like pretty much the idea of like how you can actually tune a model. Sometimes if you have a theory that you say that the model should come, the data should come from this model, you always can impose that. You can use your intuition why that's the case. But otherwise, if you want to just like you want to move your decision to something automated, you can actually use that auto-fit idea and then make your decision based upon that. And that's actually where we're going to go to forecasting, our last section of this presentation. And what I'm going to do is I'm going to look at the same data we have. We're still looking at the SPY. We're going to go back to real data now. We're going to look at the SPY returns and see whether we actually can predict that. Now, the previous slides actually taught us how we can actually identify an ARIMA model in terms of like the process stationarity and what are the optimal orders of the model. And then what we're going to look at is to see how we can actually use this model to forecast. And then our forecast will basically be based on a sample of T periods. In our case, we're going to look at daily returns. And then what we need is like T periods to fit the model. And then the other thing is that what's going to be the optimal model to use to basically actually to fit the model. So in our case, previously we showed that we use some sort of auto tuning that will tell us like where the data actually comes from. So we're going to use that function, and then we're going to apply it some sort of dynamically to see how we can actually do a forecast by fitting the model over time. Finally, the decision will be based on the quality, the data we're using, of course, and then how you can actually fit the actual model. So here's the experiment we're going to do. We're going to do like a rolling window approach. And what I mean by a rolling window, I'm going to start at a certain date. In our case, I'm going to start from the 150 observation of the time series. And then standing at time t today, I'm going to use all the historic data I have. I'm going to use actually 150 days of data. And then I'm going to fit an ARIMA model, as like I did before. And then what I'm going to do is I'm going to make a forecast for the next day. So that would be a forecast for t plus 1. And then eventually I'm going to move on. I'm going to go then to time t plus 1, and then I'm going to repeat the same experiment. Then I'm going to fit the model again and do another forecast. So it's going to be done dynamically for almost like 100 periods. So this is what I'm going to do. We have in the data 252 days of closing prices for the SPY ETF. And then we know that there's a price non-stationarity. So we're just going to focus on the returns alone. So when I'm going to use the time series, I'm going to look at the returns rather than the prices. So I'm going to try to see if I can actually forecast returns rather than prices. Now, this leaves us with 101 days to test our forecast. And then we're going to consider 3 models for forecast, to be fair. We're going to use the dynamically fitted ARIMA model, which has order PUQ, and that we're going to basically auto-tune it over time. And then we're going to have a dynamically fitted AR1, which is kind of, you can think about it as a sort of constrained ARIMA model. So we just impose that the data comes from an autoregressive model with 1 lag. And then we're going to look at a plain moving average strategy, which basically takes the average of all 100 days, and that will basically be our sort of forecast, something like as momentum. And then what I'm going to do is, this is the code in R. I'm going to use the library forecast, and then I'm going to like try to find, I'm going to at each time, so I'm going to run a loop. I'm going to start with 150 till the last day in the data, sorry, the day before last. And then each time what's going to happen, I'm going to fit like almost 101 models. 100 for the ARIMA and then 100 for AR, and then basically I'm just going to take the average for the momentum strategy. And then finally, basically, to measure performance, I want to look at how the how the performance actually compares. So I summarize the results in the end. I look at the forecast for each one, and then I will look at what is the percentage that the actual process can predict the sign of the returns. Like if you think that the price is going to go up, then you predict that the sign is going to be positive. And then I'm going to see that actually how often that happens. So out of 100 days for our forecast, I'm going to compare what the models tell me with the actual data. In that case, I compare the ARIMA model, which we dynamically fit over time. The AR, we also fit over time, but we constrain to be with one lag. And then we're going to look at momentum strategy. So if you look at the actual from returns perspective, they're all like around 50%. You can think about as randomly choosing, you will get something like as 5%. You can predict market movement. But interestingly, we can see the differences between the three ideas. One, you can actually see that the ARIMA model performs the best. One reason could be that actually we allow flexibility in the model, and that's basically could capture more fit in the model as time moves on. The AR one still kind of captures the persistence in the model, and then momentum is basically takes the equal weights of the returns. So when we think about momentum, it's kind of related to an autoregressive model, because an autoregressive model would be a sort of moving average model. But what happens is it gives more significance to the previous days. A momentum, in that case, it just basically takes equal weights, so it assigns as much importance as the previous days as the recent ones as the old ones. So you see that there's some relation between them, but we can actually find that the ARIMA model actually performs the best, just in terms of forecast. Finally, I just have like a couple of comments. So if we look at the AR model, for instance, it's kind of a constrained ARIMA. But if we just want to plot the coefficient of autoregressiveness, which basically I denote as the phi, so that's basically denotes what's the serial correlation in the returns over time, we see that actually most of the time that serial correlation is negative. But also what is interestingly that you find an evidence that there's almost like a new fit for the model. And that's the importance of actually when you do a forecast, you don't want to do a forecast for 10 periods ahead, because then you actually will have a lot of estimation error in your model. So the best thing is actually to allow the flexibility to dynamically fit the model as new information comes in. So this is just a small example how the serial correlation will change over time, and as a result, you will need a different model to identify the data. And of course, the red line is just the returns. You see like it's around 0 on average, the return on a daily basis. And you see like it's kind of like stationary, and there's some sort of contrarian behavior. And that's basically, that's pretty much for our presentation. I'm just gonna like conclude with some summary here. So this presentation, I like to start with the importance of stationarity, because it's really important when you work with data to see that the actual results are reliable and not spurious, because some sort of non-stationarity in the data itself. Of course, you can always automate trades and make decisions automatically, but I think the best way is just to understand the data, to try to look at plots and see how the data looks like, get some intuition behind it before you actually run any code. So that's also corresponds how you do tests. Statistical test is still a statistical test. It gives you some evidence, but there's also should be some economic intuition, and it's always good to see what the data is telling us. And finally, which is also kind of like sheds light on the importance of the multivariate time series. It's a more advanced topic, but when we look at forecasting especially, you want to look at different financial indicators or economic indicators. So now we just did a forecast, a very simple strategy. It's just we looked at one time series. But I think it's very important to look at how actually different time series, they correlate with each other, and how that basically can actually result in a better decision making by looking at multiple time series. So I'm going to leave that for a different presentation or a different, hopefully another webinar series at some point. But that's pretty much, and good luck good luck with your trades and decision making, and that's pretty much. So I would be happy now to take questions from the audience. Okay, so let me look at, yes.
Oh, okay. I just wanted to make sure you could find the question panel.
Oh, yeah. So I'm just looking at the, so we have multiple questions. Sorry. Okay, so there's some technical question. Find example of automated trading. Okay, so one, yes, so there's one technical question is, could you show an example of automated trading? So there's actually another webinar that did that. So you can actually find that illustration how to do automated trading. The focus in this presentation was just to look at how to actually get the data. I would really recommend looking at the IB brokers package, and it has a very nice PDF that illustrates that. And as I mentioned, there's the other webinar that was done by Yaniv. Actually, he illustrates that. So you can actually go to that webinar and illustrate that. I'm sorry that time won't allow to do that, and more to focus on looking at forecasts. But yeah, if you go through the slides, you'll be able to find the source. Okay. The other question I'm looking at, what uncertainty is within the three models? So I'm not sure what you mean uncertainty. I mean, what the uncertainty is actually comes from the data. And then if we want to look at the question is like how you can actually identify the model, and that was the question we kind of like raised at the beginning. So if you actually have a good identification of the model, then you think that you basically try to explain everything by the model, and then what you cannot explain is something from idiosyncratic in the sense of something happening outside these lag values, something new as new information comes in. Now the other thing is that yes, that's also a good point to look at the when you do a forecast, you also want to look at what's the variance in the forecast, because when we think about forecast, it's like you think about what's the expected value for that. I don't have the actual forecast for that because I looked at the at just basically the plain average. But of course, that's a very important question. And another thing what you want to do is any decision or any indicator you get, you want to get some sort of standard errors. So if you look at that 55.45%, the question is like, how reliable is that? And that's a very good question, because we're going to look at what is the confidence interval for that. So one way is, because we're looking at some sort of a complicated process, because this is a combination of forecast over time. One way is to look some sort of bootstrapping for that, and that will give you a different number of statistics for the forecast. I would be happy to put my code online, and I can add some discussion into that to include bootstrap, and that will give you some sort of what is the standard error in these forecasts. Yeah, thank you so much for pointing this out. And what's the so that's the same. What is the difference significant? Yeah, I think that's kind of applies. And then looking at the how does a shock such as yesterday meetings can be modeled? Well, one way is to look at, we just looked here as some sort of indicators looking at the, in terms of the time series by itself, right? But any event, like even if you look at stock announcements or earning announcement, for instance, you can always add like some sort of a dummy variable. So you want to add like something as takes the value of one where there's like some sort of event. So I would really recommend, like when you want to predict these, try to look at something as you have the model, but then add some sort of an indicator variable, right? So that indicator variable basically will take one if there's like some sort of significant event happening, whether it's the case for the meeting from yesterday or the case of just basic earning announcement. Because if you want to look at stock specific, you can actually go and find when it's the actual announcement. So when you fit a model, you want to take into account whether there's like special events happening. So in that case, these events are kind of like somehow are foreseen because you know that's going to be something happening then. The question whether the Feds will raise the interest rate, that's a different question, but we know there's going to be a meeting. So you still can't control for that, but we will still have some sort of uncertainty of what actually could happen. Now, another interesting, you can actually look at another, if you want to look from quantitative perspective, there's interesting models, and you look at some sort of like regime switching models. You can think about, you know, the data changes in regimes, and there's like a different cycle. So that's actually another possibility to think about. There's some sort of yeah, which basically kind of like controlling for looking at the like indicator variable, for instance, right? Anything you want. Yeah, yeah. This is Professor Shofi. Is also one of the attendants here at the Valley School. Yeah, but yeah, you can actually add any other indicators. We just limited ourselves to look at one time series, and that's my whole point by looking at multiple time series and to see actually what other economic indicators there are. And then you can repeat the same thing to see what actually captures that. So you can rely as some sort of information criteria like the one we did, what's a good fit for that model, or like try to explain what could be a spike in that. And that's my point of just like looking at the data and see why actually you observe such a behavior and what could be actually translated. Because if you think at a time series, time is something, but there's like more than time is happening. There's all these events are captured in time. So that's kind of like the same thing. If you want to think about a volatility model over time, actually there's events that causing volatility to go up or down. It's not the time itself. That's the same thing you can look at as factor models. If you want to look at a company volatility, you want to look at how that company volatility actually moves with respect to the actual market movement. So that's another thing to also to think about, look at some risk factors and see how the company actually moves with these common, like whether you look at the market portfolio or you look at other risk factors. That's something also definitely you should look at. So another question comes as, so have you tested ARIMA versus GARCH? So in this one, no, but I have worked with GARCH before. And the thing is that the question is, what are you trying to forecast? Are you trying to forecast the means, or are you trying to forecast the volatilities? So there's always like some sort of kind of like some researchers are like skeptical about whether you can actually forecast returns, especially if you want to construct a portfolio. So there's like interesting literature trying to focus on like how you can actually forecast volatilities instead, because they're kind of like associated with lower estimation error. But if you want to use a GARCH model, you can actually generalize any mean model for that GARCH model, because when you want to run a GARCH model, you're basically assuming that the time series follows some sort of mean model, right? And then you actually fit that. So for this purpose, no, I ignored GARCH. I just assumed that the volatility is constant over time. But yes, that's another possible modification can be done. And I totally agree. But in terms of forecasting, I think also would be interesting to look how we actually forecast volatilities. The nice nature of the interactive brokers data actually gives you 5-minute ticks. So you can calculate some sort of realized volatility on a daily basis and compare how your forecast of the GARCH or any other volatility model compares to the actual realized volatility. And I think you also can get some indications about implied volatility. So all of which should be actually give you a better indication what the what's the forecast for volatility. Okay, what time frames are good to work with days? Well, that's the question. In some case, you definitely want to have a good, reliable sample size to have a good fit. So sorry, that's the question again. What time frames are good to work with this? So yes, you want to think about a reliable sample size. In that case, because I looked at 1 year, so I kind of like looked at a small sample, which is 150 days. So the benefits of looking at larger sample would be that you have more consistency in terms of the reliability of your model, but also if you want to go back 20 years ago, what happened 20 years ago maybe not really representing what's happening today. So that's kind of like the trade-off. Yeah, but I would recommend looking at different time series, different sample size, and see what actually would be a good in terms of economic performance and not only statistical performance. Okay, sorry. So someone asked the summary page again. So here we go. So this is for the summary page. Oops. Oh, so okay, sorry. So I realized that Rodrigo also asked the question in terms of what time frames are good to work with. So in terms of days, weeks, hours, minutes. So one thing about if I want to look at this 5 minutes data, I want to do the forecast. The question is, if you want to look at the volatility when the market opens, the volatility will be high. There's going to be a lot of volume trades, and then the same thing when the market closes. So if I look at the 5 minutes, you want to take into account that these actually behavioral movements in the market. So if I want to actually fit a model, in our case, I want to forecast these 5 minute ticks. You want to take into account that actually what happens through the day, which kind of like complicated the forecast because there's like more things happening in that case. So one way probably as that relates to the question of the, for instance, like the meeting yesterday with the Fed. One way is to basically have like some time effect into the forecast when you look at the like smaller like minutes frequency, and actually to see how that captures part of these things that are actually happening more as the market opens and the market closes. And that's pretty much. So I have the I should put the slides after this, and I do have a part of the R code that I just was going through. So if you click on my homepage, you'll be able to go to the R corner, and then again you can actually download this R source and keep it. So I'll update that. I will include other things related to the forecast of for volatilities, and then I will try to also incorporate some of the questions we raised here and try to answer them in the code, so you can actually have access to that. Sorry, there's another question. The question says, what kind of volatility is useful to model, implied or historical? Well, I think that there's like interesting research that tries to look at, if you want to make like, let's talk in the sense of asset allocation. So if you want to create a portfolio that takes into account the volatilities, there's interesting paper in JQA, Journal of Financial Quantitative Analysis, 2013, by a famous researcher in portfolio optimization, Victor De Miguel. And what they try to do is try to look at, because what history is history, right? And then if you look at implied volatility, for instance, it should incorporate what is the market outlook is. So what their argument is basically, let's look at compare different volatility models, and let's see how the implied volatility actually works. And interesting, they find like very good performance using the implied volatility instead of looking historical or other like some sort of approaches that kind of like common. There's another thing you can actually look at. The GARCH would be some sort of historical, right? Because you're doing something from the past. But what's nice about the GARCH actually gives more importance to the recent volatilities. So it's kind of like some sort of different weighting than the actual historic ones. And that's pretty much. Is there anyone would like to have a question? So please type it in. We still have like 10 minutes to go. If not, uh, I'm happy to answer any. And yeah, feel free to send me an email. Again, you should be able to contact me through my RPI email, or feel free to add me on LinkedIn. And I will put some updates on my. I still kind of have like a very. It's still like a very initial R corner that I did. But here's a boot camp. Also, if you're interested like in learning something about basics in R, there's a small boot camp that we did here at the school, so you can actually find the slides and some exercises we did. And then I started doing an app for R. You can use this app. It uses the package. It's outside Interactive Brokers, but you can actually look at data. So if you don't really want to code to get data, you can actually just use your mouse and get some data from that. So that's pretty much. And feel free to send me any email to ask any question. And
all right. Well, oh, one more question, Majid.
Okay. Oh, sorry. I couldn't run XLS on. You mean XTS or XLS? I'm not sure if I used any XLS. You mean the package? Oh, XTS. You make sure that you have the updated package or the updated version of R. So that could be the case because it's kind of like a recent package. I also would recommend, if you want to try to go like through the DataCamp website, they actually have a good crash course on how to use this package by the author himself, Jeff Ryan. So that would be a very good source to actually learn more about how you can manipulate time series. Yeah, that's the question was raised by Ricardo. Yeah, I hope this helps. Okay.
Well, Majid, it looks like, thank you very much, by the way, but it looks like we are going to coming to the end of today's session. And I want to thank you very much for all the work that you've put into this and for sharing your expertise with us here today. I also would like to remind everyone that we have been recording today's session, and I will be sending a link out to all of you shortly after the event ends. So if you do want to come back and review any of the concepts that Majid has talked about during today's session, be on the lookout. Just watch your inbox for a direct link to the playback. Now, this event, as well as the previous one that we did just a few months ago on trading using R at Interactive Brokers, they'll both be listed on our Interactive Brokers website. Underneath the education menu, you'll find a webinars link where you can drill down and find both today's and previous sessions that we've done as well. So with that, looks like we are going to conclude today's event. Once again, thanks so much, Majid. Do appreciate it. And would love to have you back again to talk about more. Well, and I want to thank everyone who's also attended today's session. We do appreciate your time. You can all exit using the X in the upper right-hand corner of the screen and be on the lookout or watch your inbox for a direct link to today's recorded playback. Now, we'll also be including the slides that were available, so if you do want to go in and find addresses and home pages and links, it will all be included in that follow-up email. So looks like that's going to conclude our session for today. Thanks, everyone. Have a great day. And please all do remember to trade smart. Thanks, everybody. Have a great one.
Thank you so much.